Hello everyone, thank you for joining us here today. My name is Ed Modla, the Director of Retail Education at the Options Industry Council. I hope everyone is doing well from both a health perspective and a financial perspective. These are stressful times for everyone, and I hope you have all been able to navigate this environment as good as you possibly can. I'm going to talk about a few protective strategies today. One of them is a hedge on a stock position, and the other one to repair a stock position using examples and highlighting some concepts along the way. First, our disclaimer. Options are not suitable for everyone. They are a complex tool that does require dedication and study before you use them in a live account. I will have examples and calculations in today's presentations that do not include certain costs such as commissions, transaction fees, margin, or interest. Those are important costs in a live account. I'll keep things simple today. And the strategies discussed, this is important, the strategies here are educational, and that's our purpose today, not to endorse them for any particular market environment. Briefly about OIC, we were founded in 1992 to provide free and unbiased education to the investing public. You can find us at our website, which is optionseducation.org. We have a plethora of videos, podcasts, webinars, and you can also browse through our events section, which lists all of the upcoming events, specifically the monthly webinars that we produce, such as these. Also, the guys at the Investor Services Desk can be reached by email at options@theocc.com. That is a free service where you can ask options-related questions. That team is also behind the scenes right now during this webinar answering your questions live. Hopefully they can get to all of them. If I have time, I will take a few myself. But they'll respond to every single question that comes through either live or by email in the coming days. Also want to remind everyone to please take the survey that is attached to this presentation. We look at every single comment, every single piece of feedback that we get. It helps us shape the program moving forward with not just the topics we select, but the order of those topics, the speakers. Every bit of feedback is helpful to us, so please take the survey. I'm going to start before getting into the outline, spend a few minutes here on the volume slide, just because of what's been happening in the market recently. Looking back for context, you can see the explosion of options growth at the turn of the century. We had a spike in 2011. That year saw increased volatility due mostly to the European sovereign debt crisis, and then a period of years where there was extremely low volatility. And if you look on the left, the number of contracts traded in those years, 2012 through 17, roughly 4 billion contracts, was followed by periods of increased volatility, again in 18 and 19, where we set records right there around 5 billion contracts in those calendar years. And that comes out to roughly 19.8 million contracts traded per day. That's the record-setting level, record-setting pace that gets you to 5 billion. Now here we are just past the first quarter of 2020, and of course there's been a tremendous amount of volatility in the market recently. Usually that translates to higher options volume, but the key point to recognize here is it's not just higher volume, it's record-setting volume by large numbers. So far, year to date, the industry is averaging just under 28 million contracts traded per day. Again, the record-setting pace was around 19.8, and right now, just under 28 million contracts per day, averaged out over the year. That's about 7 billion per year, and I certainly wouldn't expect this pace to maintain itself throughout the whole year, but that's what we've been seeing. Certainly, this is no time to celebrate or to feel good about the industry, because we know why this is happening. People are stressed. They're concerned about the health of themselves, their families, their neighbors, and they're losing money. And it's not the best circumstances, but it is a time for reflection on the industry. And while the market is the most stressed, we are witnessing investors continually turn more and more to the options product. In March alone of this year, there were over 670 million options contracts traded. And I think that speaks to the value of the product, its flexibility, the way it can be used to manage risk and to tailor positions to the investor's liking in a way that other products just cannot do. So these numbers are trending higher, and in times and periods of market volatility and stress, the numbers are record-setting. So to our outline for today, I'm really going to focus on two strategies, the protective put and the stock repair strategy. Different circumstances are going to lead you into each of these, and I'll walk through some details of each strategy, how they're put together, managing the position, exiting them, and throughout the presentation today, maybe offer some insight and some commentary that might be relevant to current conditions, along with basic level education, specifically in the beginning. So there should be something in here for everybody, whether you're just getting started and you're new to this terminology or you have an advanced background in options. Hopefully you'll find the information today useful. I'm going to start with the protective put. And this strategy consists of two pieces. It's long stock and long a put option. So let's dissect what that is all about. Certainly if you're long stock, you are bullish and you're expecting the stock to move higher so you can profit from that. And in order to protect the downside, you own a put option. And I'll walk through the basics in just a second, but the put option provides a floor price or an exit point. Before I get into the basics of put, let's just compare this strategy to insurance so you can get the right mindset around what this trade is all about. This is the classic form of buying insurance on a stock or a portfolio. People buy insurance on their homes, on their cars, on their health, and this is how you buy insurance on your financial portfolio. So normally, anytime you have insurance, you don't want to have to use that coverage, and that's the same case here. This is considered somewhat of a sunk cost if you don't need it, but something that is there in case disaster strikes. People don't want to use their house insurance or their car insurance, but it's there in case you need it. Same thing here with your money. You can choose when to buy insurance, and you can tailor that policy to your liking in various ways, but you're hoping that you don't actually have to use it because, keep in mind, you are still bullish on the underlying stock. You're bullish on the market. You just want to protect yourself against disaster, and that is what the protective put is all about. Back to basics, Options 101, the rights of put buyers. Anytime you buy an options contract, you own the right to execute a transaction in shares of stock. You pay the option premium up front to receive that right. In the case of put options, the owner or buyer owns the right to sell shares at the strike price, and they've paid for that right. And what it means is if you take this through exercise activity, the owner of the put option has the choice to exercise if they choose and receive in cash the strike price times 100 and in turn deliver or sell 100 shares of stock. Now, as an outright position all by itself, buying a put option is a bearish strategy. You think that through. If the stock is at $45 a share and you buy a put option with a strike price of 40, well, as the stock moves lower and it goes to 40, 35, 30, the right to sell shares at 40 gains value. It gets more and more valuable. The stock moving lower has a positive influence on the value of what you own in the form of the 40 strike price put. So this is a way to capitalize on a bearish market that's moving lower without having to go in and short stock. You can buy a put option and profit off of market corrections. And for our purposes today, that's not why we're using the put. Today, the protective put is going to protect shares of stock that we own that we are bullish on. So two pieces now join together, which changes the dynamics. This concept of insurance, buying a put and having the protected put on is very similar to insurance, and the terminology, deductible, premium, expiration, all apply here and can be translated. So let's start with this idea of deductible. In an insurance policy, the deductible is the amount you give up or pay before the coverage begins. If there is an accident or a fire, you are liable to pay a certain upfront amount in the amount of the deductible, and then at that point the coverage kicks in and becomes something you can utilize. In this case, the difference between the strike price and the current stock price is that amount. Again, if the stock's at 45 and you buy a put option that gives you the right to sell shares at 40, that first $5 of movement to the downside, you do not have coverage. That is similar to the idea of a deductible. You give up the first $5, then your coverage will exist below that level. If the shares plummet, the investor can then sell stock at the strike price no matter how low they go. Shares can go down to 35, 30, 25. You own the right to sell shares at 40, and that right does not change. Now, if the shares don't go down, again, if you have insurance, you don't want to use it, so if shares do not plummet and they consolidate or flatten or even rally, then you don't need the insurance. And that is a mindset that you have to become familiar with or be comfortable with. If you don't need the insurance, you cannot look back at that as though you wasted money or you lost money. It is the cost of doing business if you want to have insurance. Again, if you have a car insurance that expires and you didn't need it, it's second nature or instinctful to buy more insurance and reestablish that policy. A little bit different mindset in the financial world. When you don't need your put option and you don't have that stock correction, you may think you wasted money on the put and not want to do it again. And then that's a choice you can make. Do you want to have insurance or not? There are other things you can do as alternatives to buying a put option. I'll get to the stop loss order in a little while and make comparisons there. But something else you can do is just toggle your cash position. For example, if you're 70% invested into the market and you're holding 30% in cash, just very simple generic breakdown, and you've become concerned about the market, you can toggle your cash position to become much greater and lower your market exposure. That's one way to protect the position against losses. Now, if you do that, since you've lowered your market exposure, you don't have the upside potential that you otherwise would, but it's still a choice of yours to avoid having to pay for insurance. You can take that route. That's what the deductible is. And of course, there's premium and expiration as well that we're going to get into. But let's just take a quick snapshot of where we're at, what we've covered. The strike price of the put option you purchase determines the exit price of your position. That's the price at which you own the right to exercise the option and sell shares. You can also use this strategy to protect profit. Sometimes you may buy shares of stock and immediately or closely thereafter buy a put option to protect the position close to your entry point. But some other situations may arise where you have a long-term gain in a particular underlying. You have nice profits that you don't want to give up. And that could be a condition where you decide to purchase a put option to protect against giving back all of those gains that you've experienced from an investment that has gone well. And if you do that at a certain circumstance, you may actually be able to lock in profits. If you've had a sharp enough rally to the upside, you might be able to implement a put option where you can sell shares or own the right to sell shares at a level that would still be profitable. So there's a little bit more detail on deductible and conditioning. Now back to the terms of the insurance policy. You can choose how expensive the insurance policy is going to be and what kind of coverage you're going to get. The first decision here is what strike price are you going to select. And you can see if shares are at 56.5, you go to your screen or your options quotes and you look for put options. Well, it makes sense that the higher strike put options are going to be more costly. Owning the right to sell shares at 55, for example, is going to cost a lot more than owning the right to sell shares at 47.5. And then the costs are going to be weighed. You're going to balance that. Now back to the deductible aspect. If you buy the 55 put, it's a lot more expensive, and your deductible is only $1.50. The difference between the share price of 56.5 and the current strike price of 55, you only give up $1.50 before the coverage comes in, and you pay for that. If you go all the way down to 47.5, that's a $9 deductible. You're giving up the first $9 before your coverage begins, and you pay a lot less for that. So there's probably not a strict decision on what strike price you're going to choose. In other words, each situation is unique to itself. And you might want to analyze just how much protection do you need, how concerned are you about the downside, and then weigh that against the prices. One way to do that is just to start with what level of a deductible are you comfortable with. Start there. And that will point you to a specific strike price. And once you see that strike and its premiums, you can then further analyze, is that the amount that I want to spend? Is it too much? Maybe I have to go lower and accept a higher deductible, or was I willing to spend more? If you're willing to spend more, maybe you can go up in strike and get even more protection. So that's a balancing act on strike prices. Similarly, and just as I would say intuitively, is choosing your expiration date. The longer you go out in time, the more expensive the insurance policy is going to be. The stock's at 56.5. So you select the 50 strike put. Now 15 days is going to cost a lot less than 90 days. So there's a couple ways to look at this. First of all, if you're an investor who always wants the protection, then you may start going out further in time, buying that 90-day, or maybe even further if the options go out to 120 or 180 days. You might look out that far and buy your put option for protection, and then as it approaches expiration, you may execute what's called a roll out. What that means is, let's say the long-term put option is now 20 days till expiration, and what you would do then is sell the option you own and buy a further out option. So then you roll out to a longer-term expiration date and maintain the protection that you wanted. So another way to look at this, I said you might have protection all the time. You might otherwise, or alternatively, have a specific event in mind. And this could be earnings or drug trials, a government contract, some type of major announcement that is going to occur, and you want protection for that announcement. And that is the example that we're going to go through as we walk through the protective put on stock. And here is the situation. This stock symbol, JETX, is due to finalize some government contract negotiations, and you own this stock, and you're bullish. You think the contract is going to go well, and the stocks will appreciate, and you want to capitalize on that move higher in share price. Of course, if things don't go right and you get surprised, there could be a huge reduction in share price, and you want to protect against that. This situation lends itself pretty well to the protective puts. Let's take a look. Long stock from 80, looking for downside protection over the next couple of months. You go to the options chain. And again, the higher strike put options will cost more. The longer dated expiration dates will also cost more. Let's say we choose the April 75 put option, currently bid 265, ask 271. We're buying this option, so we would have to buy it from someone who's selling it, which is the ask price of 271. Most investors use limit orders. We can be aggressive here and put in a limit order to buy at 271 to try to get that price, or maybe even 272 to be more aggressive. But let's say we're comfortable just going right up next to that offer at 270 and buying the option there. So we pay 270, that's 270 net dollars. Remember, each options contract is written on 100 shares, so the investor is long 100 shares and buys one April 75 put option for $270. If things go our way as expected, this government contract is approved and the stock rallies, and we didn't need the insurance. We spent $270, didn't need it, but hopefully the rise in value of the stock position will well offset the losses of the insurance policy. If things don't go the way we expect them to go, and we're surprised, and this government contract is not approved, shares can plummet down to 65 or lower, 60, 50, 40, doesn't matter how low they go, the put option held provides the investor the right to exercise and sell stock at 75. Another alternative way to manage this position is to sell the put back to the market and reassess. This is a difference between using a stop loss, which I'm going to get to again very soon here, but the one thing you can do if the stock drops dramatically and has reached a point where you think it's going to turn around and move higher, you don't have to exit the position. You can sell the put, capture all of the value and premium attached to that, and then reassess your outlook and maybe hold the shares, hoping for a bounce or a pull back. Now I want to put that into a chart. It's very useful to take these kind of examples and then visualize them on a P&L graph. We have the long stock from 80. We're buying the 75 put in April. Now you can do a calculation here. The premium represents 3.4% of the investment. Now this is calculated as the cost of the insurance, $270, divided by the cost of the 100 share position we bought at 80. So 270 divided by 8,000 gets you that 3.4%. That's how much of our investment we spent on the insurance. And you can use that number to analyze one position versus another. You can compare different put options by looking at how much of an investment it would require. Of course, going lower in strike price provides less protection and would be less premium, but this is another tool you can use for helping select your strike price and expiration date. When we look at a P&L graph, it's always very handy to draw a table like this and just get a snapshot. Put the stock price at various levels at expiration. What does this position look like? Emphasizing the downside here, because that's where the protection is. This position cannot get any worse than losing $7.70. You can think of that very quickly as the deductible. Our long position from 80 down to the strike of 75, that's $5, our deductible, plus the cost of the insurance itself, which was $270. $770 is as bad as it can get, no matter how low the stock goes. The stock rallies and goes up above 90, into the 90s, into the hundreds. We keep gaining on the stock, and we lost on the insurance. So the total profit will gain in value, and we will experience healthy returns while acknowledging that the cost of insurance worked against us. And here is the profit and loss graph that is very handy to look at. So you can visualize long stock at 80 versus the protective put. We have underperformance at all of those levels, 80 and above or slightly below 80, because we paid for the insurance policy, but the protection there, the max loss, is the big benefit of buying a put option. So how about the what if scenario? So what if the stock goes lower? As I said, this is position management. Now, what if the stock goes down well below 70? You can hold it, you can wait it out, you can exit the position, or you can sell the put option and reassess. You have different things you can do. That's the worst case scenario, is the stock drops dramatically, but there's different ways you can handle and manage out of that position. Now, if the stock consolidates, doesn't really move, or goes higher, what's going to happen is that put option is just going to erode and go away. So the other situation is the stock stays above 75, or even well above 75. And in that case, you can treat this just as a long stock position, with the put option eroding and gravitating down towards zero. The one thing I will say about it is, at some point you may think about, especially if the stock's around 75 or in the high 70s, you can think about selling your option. But just a little side commentary, when the option value loses enough, or it gets close and close to zero, at some point it might not be worth selling. At some point the premium you receive might not be worth selling it, and it might be just in your best interest to hold it in case of a disaster, because the premium you can get from the put may erode a little bit too quickly. So in comparison to a stop loss, if there's an alternative to using a protected put, one of that would be toggling your cash position, or you can just use a stop loss. You might say, well, I don't have to pay anything if I use a stop loss, and that's true. And that's the big advantage of a stop loss versus the protective put, is a stop loss doesn't cost anything. The protective put will cost you and can be considered expensive. In exchange for that cost, you do get some enhanced protections. First of all, 24/7 protection with the option. You don't get that with the stop loss. There's been numerous occasions where overnight activity, specifically over weekend activity, has caused the market to open up much, much lower. There's been a number of examples of the market opening up significantly lower on Monday morning. If you closed the trading day on Friday with a stop loss and the big move lower occurred on Monday's opening print, the stop loss didn't get you out where you want it to, whereas the put option is there working for you, provides you that exit level at the strike price 24/7. You can also hold this position through expiration. I alluded to this earlier. As soon as the stock reaches your stop loss price, you're out of that position. As soon as it trades there, that's it. You're done. The position is closed. With the put option, you don't have to be tied into that. You can hold the position, you can reassess, you can wait all the way up until the expiration date of the option contract. You're protected all that way through, all the way down. So you don't have to get out of the position. This is probably the best example. This would be a flash crash, a very quick move lower where a stop loss would be triggered, but a put option would not, and the subsequent rebound would be something that you could take advantage of. And then I just alluded to another difference. In favor of a stop loss is the fact that put options expire. And if you do want to have protection long term, you will be in a position of buying a fairly expensive long-term put, or buying short-term puts and rolling them out and continuing to have to pay for them. Stop losses don't expire, but put options do. So there's some managing the position commentary and some alternatives, and that's buying a put on a stock position. What about a portfolio? It gets a little more interesting here, and this is the second example. The investor has a $100,000 portfolio, largely reflecting a broad-based index, and that's the key here, being able to identify an ETF or an index that closely reflects the portfolio that you have. And this investor wants to buy protection in the form of a put option and execute a protective put on their entire portfolio without having to go in and buy puts on each of the stocks that they own. They would just like to use one symbol covering the broad market and buy a put option there. So let's start with our example. The portfolio is $100,000. The desired protection is to have coverage beyond a 10% move lower. This is the deductible. The investor is willing to lose the first $10,000. Beyond that 10% move, the investor wants the put option to provide coverage. So the key now is to find that ETF or index that you think will closely resemble the performance of your portfolio. Let's say we have found that ETF. It's trading at $250 a share. Well, since we're going to give up the first 10%, then we're going to look for the option strike price that is 10% below its current level. If that 10% downside move occurs, the $250 ETF will now be trading $225. That's 10% lower, and that is going to be our targeted put option. Going to the options chain, we can then further see that the 3-month $225 put is trading for $3 per contract. I'm going to deviate a little bit here off of the outline just because of our current environment and talk a bit about volatility. Just for starters, the definition. Now, options are forward-looking, specifically between today and expiration date. Pricing an option requires some estimation, or you can say guess, at what level of volatility are we going to see between today and expiration date? Well, no one knows that answer. We can look back on previous moves of the market or of a stock, and that's looking back at historical volatility, what has happened in the past. It's factual, and we know what that number is, and that can be a guide that helps us determine what the future volatility is going to be. That future level that is used to price an options contract is called implied volatility. And as that increases, the future potential volatility increases, the price of options increases. That follows common logic. As the potential for wider and wider future values of the stock or the market increases, then the option prices will increase across the board. To put these premiums into some context, we ran these numbers with normal traditional volatility levels as this presentation was constructed, but today, as we're here in mid-April, a similar ETF looking at about a 10% out of the money put option at today's volatility levels might cost around $11 or $12, about 4 times what you might see in more calm or normal circumstances without this level of elevated volatility. It's important to know when you make a trade what is the volatility level that you're buying or selling, but you don't necessarily have to have an opinion on whether it's high or low. That's a deeper analysis some investors may do, many investors will not do, but it is important to help understand what you're paying for and then track that level over time. As the stock moves, as days pass, as volatility changes, you'll have a much better understanding of why the option price changes as it does. Stock price movements, changes in days to expiration, and changes in volatility, they all have an effect on the option price. Back to our example. We've got a $100,000 portfolio, deductible is 10%, and here we have identified the option. The question at hand is, how many of these options do we need to buy? And I think this is less intuitive to answer this question, but a very simple calculation. The total amount of dollars that you would like to protect is $90,000. You divide that by the notional or aggregate value of the strike price, which is the strike times 100, or $22,500, and that equals 4 puts. To state this a little bit differently, might be a little more clear, I explain it this way. If everything goes to zero, if the entire market goes to zero, you will have lost $100,000 in your portfolio. You wanted protection on $90,000, so the put option needs to pay you back $90,000. Each one of those put options will pay you the strike price times 100, $225 times 100. If you want to cover $90,000, you would need 4 of those put options to recover that entire amount. And that's how the calculation is done. That would equate to $1,200 of total premium. And from there, you can decide how much you want to hedge. How much protection do you want? How much do you need? And you can decide to buy fewer, 3, 2, or 1 puts, or you can buy more. You can over-hedge a position, and you can do that intentionally if you want to have even more downside protection. And of course, you can choose different strikes. We stipulated 10% out of the money. That identified our strike price. If the cost of that strike was not what we wanted to pay, we can move that strike up or down to fit our liking. And of course, we assumed doing this calculation that the ETF we chose and our portfolio have a 1-to-1 correlation. That is not likely to be the case, but hopefully there is a very high level of correlation between the two. I'm not going to walk through all these numbers, but it's helpful to look and just see. So you highlighted the 225 strike. That is the level of where we bought the put option. And we have the different levels at expiration of the index or ETF. And as the ETF rallies, you see if it goes up to 300, that's a 20% gain in the ETF. Now, all the way on the right column, that's the important one, the expected portfolio gain or loss combines the portfolio and the put option. You can see the portfolio is going to gain very nicely, but it will underperform the portfolio that doesn't have the hedge, that doesn't have the put option, and it will underperform by the cost of that hedge, which is 1.2%. The benefits of the put are the downside. Once you get to 225, the coverage begins, and if there are big losses, 20%, 30%, the unhedged portfolio continues to mount losses, while the hedged portfolio on the right has a capped loss at 11.2%. And again, all of that protection there has an expiration date. So if this all looks good, you do have to keep in mind it expires at some point. If you don't see that correction, you will have to reestablish the hedge if you want to continue to have it. So we're looking at protective put a couple of different ways. Now there's one, the strategy that I don't think gets quite enough attention in this industry and from an educational perspective, and that is stock repair, which is a little more complex because there's several moving parts to it, but certainly can come in handy when you have a losing stock position that you're trying to get out of. The consistency here between the strategies is that you still need to be bullish. You're holding shares and shares have gone against you, but you're still bullish. You don't necessarily want to exit, but you want to manage this position a little bit differently to help you get out of the position at a better level. And that's what we're going to walk through here. So what is it? It's a ratio spread using only call options in effort to lower the break-even point of a position that has gone wrong. That is the objective of this strategy. Lower the break-even point to make it much easier for you to get out of a position that has suffered losses. Now you have to give up something. Anytime you evaluate an option strategy or compare strategies to each other, there is something you're going to have to give up. And as you'll see when we walk through the example, you give up the potential for profits to the upside should the stock turn around and rally sharply. You gain a much lower break-even point, you don't have to pay for it, and you don't take additional downside risk. Those are all huge benefits. What you give up is the potential for big profits if there is a sharp rally. Now, if you have a losing position and you're sitting trying to decide what to do, first and foremost, you might just get out of the position. You might just say, well, I'm taking off. This didn't work out. I'm closing and moving on to the next trade. And of course, there's no options to overlay on that. But if you do have and maintain the bullish outlook and you'd like to capitalize at least a little bit on the move higher, you can hold the position right where it is and do nothing and keep the risk profile consistent with long shares. Or you maybe buy more shares. You can add up the amount of shares you own. That costs a lot more money. It will lower your break-even point, but there's a significant cost to that. And And you also have higher risk because you spent more money. So there's some considerations when you're putting this together. Now let's walk through how it looks if you do take the route of doing options instead of either of those two. And here's what the stock repair looks like. Long 100 shares from 65, and due to recent market declines, shares have sold off all the way down to 57. Now this investor is still bullish from 57, but they don't think the stock's going to rally sharply up into the high 60s, into the 70s. So they wanted to get back to break even a lot more quickly without spending money and without taking additional risk. Staying the course is just a hold and hope, do nothing. Buying 100 more shares would require an outlay of capital, much higher risk, and we'd get the break-even point down, but at significant cost. The call front spread, which is another way to refer to the stock repair strategy, doesn't cost anything more and does not increase the downside risk, while it does reduce the break-even point to 61. Here's how it's put together. Long 100 shares from $65, and the shares are now trading at 57. So that's how you start this, looking at the current share price level of 57. That is at the money, and that is the call option we're going to buy. Buy one, 57 call on our example here, right in between the bid-ask for 96 cents. And then the call strike that we sell is halfway in between our entry point and the current level. We originally bought shares at 65, now it's trading 57. We buy a call there, that's $8 lower. We go right in between those two, right in the middle, and sell two 61 calls for 48 cents each. Pay 96, receive 48 cents twice. The options piece is done for even money. Now, we know buying a call option gives us the right to buy shares. We have a right to buy another 100 shares at 57. Selling two call options, we receive premium for that. Now we're under the obligation to deliver or sell 200 shares at 61. One of those would be against the call option we bought, and the other one would be against the 100 shares we already owned. So that's the right and obligation part of this trade. We own the right to buy 100 more, and we are obligated to sell both the shares we own and the shares we have a right to purchase at 61. Here's the P&L graph looking at share price at expiration. It's long shares from 65, and we have the option overlay on top of that. As the stock drops, see the long stock P&L, as the stock price goes down, is going to equal our net profit and loss with the option strategy. We took no additional risk. We have the same risk. No put options in this strategy at all. The same risk as owning shares of stock. However, what you can see is that just owning shares, let's focus on that 61 level, just owning shares of stock and doing nothing else, when we get back to 61, we're still down $4. But that's when our option starts to pay off for us, and the net P&L there at 61 is going to be break even. We've lowered our break even point by half, or in this case, $4 without spending more money and without taking additional risk. And here's what it looks like on a profit and loss graph. You can see this looks a little, there's a few turns in here, but under 57, we have a profit and loss that is consistent with long stock. Above 57, now remember, we're long 100 shares, we have the right to buy another 100 shares. So we start to make money back above 57 a lot more quickly, because we've now effectively doubled up the long position from 100 to 200. And once we reach 61, we do not have the ability to profit further from a big position move, a big stock move higher. Now, the what-if situations here, well, certainly if the stock does continue to sell off, the options really, they didn't cost anything. We did the trade for even money. They're going to expire worthless. The position is just exactly the same as if we had owned shares of stock and did nothing. If the stock rallies sharply and goes all the way up into the high 60s, like not much you can do from a position management perspective. The options are going to profit for us, get us that break even of 61, but we've given up the upside potential if we hold this position and the stock rallies significantly. But what if it sort of stays in between those two? That's where it gets interesting. If the stock, say, closes at $60 at expiration, and so now we have the 61s that are out of the money, they're worthless, they go away. We've got the 57 call that is $3 in the money. Well, here's where position management comes in. How confident are you in the bullish move? There isn't a right or wrong answer here. At this point, you might be very happy with the fact that you've made back most of your money. And at $60, you can go ahead and exit. Or alternatively, you might, on the other side, be very aggressive and decide that that move down to 57 hit a support level. Now it's moving higher significantly. So you might exercise the 57 calls and take 200 shares that way, break-even point being 61, and let that go. Or you can sell the call. If you want to keep just 100 shares of stock, the 57 call might be trading for around $3, and you can decide to sell that for $3 and hold the 100 shares. Again, you can always just close the whole thing out. So there's different ways you can manage the position. It gets a lot more interesting when you're in between the strike prices, and different ways you can do that. Now, as far as premium, getting this trade executed at even money is the idea. That was the objective at the beginning. And it's a little easier to do that if the expiration date is longer in duration. And I'll explain that. One of the things that I had learned 23 years ago when I began learning options on the trading floors was when you're thinking of a question or trying to come up with an answer, it is often useful to think of an example and push that example to an extreme situation. And then the answer often becomes common sense, becomes very clear. And so if I were to ask you, we're trying to execute the options at even money, is that better to do or easier to do with short-term options or long-term options? My suggestion is push that to an extreme, and instead of thinking it in generic terms of short-term and long-term, let's think 1 day versus 1 year. And just think about it that way. Now, for 1 day until expiration, the premium amounts of the out-of-the-money options are going to drop off very quickly. The stock's at 57. The at-the-money option is going to have value, but the 58s, 59s, 60s, and certainly the 61s, we're not going to have any value there. So when you go really short in duration, the premium of the option you sell might not have much there. It might not be worth selling, and it might be much more difficult to execute the options piece at even money. Longer term, different story. You have a lot more time. The value of options will fan out from the at-the-money level, and you'll have a much easier time going long term executing the trade for even money or better. That sounds good, but you also have more time for the trade to work against you. You might be stuck in the position for longer if you go long term. Now, what about volatility? That's another question. Are higher vol environments or lower vol environments going to assist executing this particular ratio spread at even money? And again, think about it in an extreme situation. What if volatility was non-existent, was very, very low? Well, once again, the out-of-the-money option premiums would drop off very quick with no expected movement, no volatility at all. You would not expect out-of-the-money options to have much of value, if at all. But with very high levels of volatility, you would expect option premiums across the board to gain value. And we're selling 2 calls here. So higher volatility and longer dated options make it easier to execute this trade for even money, but there is other sides to that, as the longer dated position may hold you there longer than you want, and the elevated levels of volatility may leave you in a position itself, the long stock position, that certainly has more risk than a low volatility environment. And so I think you'll find that stock repair to be useful. Sometimes when you have a losing position, it's best just to get out. Sometimes doubling up is the way to go if it's hit a strong support level. But here's another strategy to put in your toolbox, the stock repair strategy to get you out a little bit earlier. And then just to recap where we're at before I get to a couple of questions, optionseducation.org is where you can find us. Check out the events section on our website and see what we have coming up. The investor services team can be reached by email, and there's our social media outreach. Please follow us on YouTube. We have plenty of videos and past webinars on our YouTube channel that you can check out. And again, please take the survey. So let me browse through and get a few questions. Is it possible to buy a long put without being long in the stock? Well, it certainly is, and buying a long put without owning shares of stock is the bearish position, and that would be consistent with expecting the move lower in the market to occur and hoping that your right to sell shares will profit as the stock moves lower. You likely will not have any issues with permissions when it comes to this particular example. So buying a put option is certainly something you can do without long stock. It changes the dynamic completely. Buying puts outright would be considered bearish, where owning stock and buying puts is a bullish position, and it changes the market outlook. Another example, another question here, with the stock repair, what happens if the short calls are exercised before the long call? You won't be able to deliver 200 shares. Great question here about exercise and assignment. You know, certainly if you are long 100 shares and you get assigned on 2 call options, you don't have shares to deliver, and you're going to end up, if you do nothing and that happens, you'll end up long 1 call option and short 100 shares of stock. Now, from a risk perspective, you're still covered that way. From a risk analysis, you have nothing to be concerned about because any move higher in the stock is offset by your long call option. But maybe the perspective of the question is, well, I don't have enough, I don't have the ability to be short stock. And that's something you do have to manage through. This would be a great question to ask your brokerage firm, what happens if this occurs? Now, one detail I want to make sure everyone's clear on is, when might you get exercised early? Well, certainly it could happen in theory at any time. But as a dividend is approaching, if the options are in the money and a dividend is about to be paid, that is usually the circumstance that lends itself to an early exercise. But it's a great question, and again, from an educational perspective, there's no change in the risk profile. It really is a question for how is your account going to be handled. Are you allowed to be short shares of stock and long a call, or are you not? And how will your account be handled? That's a good question for your brokerage firm. Another question from Sanjay, for the protective collar on your example, can you walk us through what happens when the stock goes through your 61 strike price? Well, yeah, let's just put the P&L graph back up. If it goes through 61, and let's say it goes far through 61, up to 65, I'll just say it in 2 ways. In the absence of exercise and assignment activity, that is early, okay? In the absence of early exercise activity, the 57 call option, we own. We have the right to buy another 100 shares there. That would leave us with 200 long shares. However, the 2 short 61 calls will also be exercised. We're short those, so we'll be assigned and have to deliver 200 shares. So if the stock's at, say, 65 or 70, and we do nothing at all, and the 57s and the 61s all go through exercise and assignment activity, the resulting position is nothing. We are flat. And that's what will happen if no activity is taking place. And I kind of just covered what would happen if there's early exercise. In that situation, we might be left with a short stock position. Good question for your brokerage firm. I see a lot of questions coming through now. The board is really getting filled up. I'm getting close to time, not just on the clock, but on my voice, which is giving out on me. So I want to thank everyone. Please keep the questions coming through. The guys on the investor services team are working to answer those, and they will get to all of your questions either today or in the upcoming days. And please take the survey. We really do appreciate all of your feedback, and we look at all of the comments and suggestions that we get. Once again, I hope everyone is staying safe, is staying healthy, and is protecting themselves both from a health and financial perspective. We hope to see you at our future events. Thanks again for attending, and enjoy the rest of your day.